So we have a great panel, and I'm sure you know everybody here, but let me just go through the names. Basically, everybody has been associated with PEPM, so we are very proud to have this tradition and that we can show off. You see, the beauty of this is that everybody was willing to come, very excited, and of course we are too. So to my left, I have Rich Clarida, who was a PEPM faculty member from 1992 to 1996. He's the C. Lowell Harris Professor of Economics and Public Affairs at Columbia University. I'm not going to go through their papers and things because we have just 1 hour, and these people are very famous. So they need no introduction from that standpoint. Ron Finlay, a very close friend of mine, I must say. We know each other for years since we came here in 1973. So, but Ron has been associated with PEPM from 1992 to 2008, on and off. He's a Ragnar Nurksey Professor of Economics. Michael Gavin was director of, where's Michael at the end? Okay, because I wasn't going according to this line. So Michael is the one at the far left, believe it or not.
Just you wait.
He was a PEPM director and faculty member from 1992 to 1994, and he's now managing director and head of emerging market strategy at Barclays Capital. Francisco Rivera Batin, to his right, was director of PEPM, is the one who spent more time, he has the record as director of PEPM from 1996 to 2002, professor of economics and education, Teachers College, Columbia University. Let me just start very briefly by saying some things that are familiar, but are maybe worth repeating. Obviously, we are all very concerned about what's going on in Europe at this point, so hopefully some of that will come up in the discussion. And the challenges, the problem is the challenges that we are facing, you can call them unprecedented, although there are some precedents, but they are very different from what we need to know now. So if you take the 1930s depression, you can learn a lot, and obviously some of that has been applied presently in the present Great Recession. But that experiment, from an economic point of view, was kind of stopped or interfered by the Second World War. So there's a certain shock, a very large shock, that brought about big changes in fiscal policy, particularly, which are not applicable under the present conditions. So there we have a problem. How to learn from that experience? We have plenty of experiences from emerging markets, but the issue is that those crises took place during the period of great moderation in the North, so those countries could recover quite quickly, partly because they could export their way out. The situation now is more complex. And finally, we are facing a liquidity crisis, so this is not the run-of-the-mill recession and output or technology recession with which we have much more experience over the years after the Second World War. This is a liquidity crisis that we didn't expect it would take place in advanced economies. So the way I see this liquidity crisis, there's been a lot of creation of fake money, and now that fake money is coming back to haunt us. And so the drachmas became euros, and now the euros in that part of the world, in a sense, are becoming drachmas again. So, and the same for other places. So this is a very difficult problem because it involves new instruments, and so you have to figure out and think a lot without the help of facts from the past. So let me stop here and let me go in that direction, and please, Rich.
All right, well, thank you. And it really is a treat to be here today because, as was indicated, I did teach in the PEPM program, as many of us did, and in particular, as you all know, but just to remind everyone, this was really Mike Gavin conceived of this, brought it in to being, so really much more of the director. He's really the George Washington of the PEPM program.
I think he's the Alexander Hamilton.
And Alexander Hamilton, too. So.
David Bloomer, George Washington.
Exactly. But I only have 9 minutes now, so let me jump into the topic of the program. So the economic policy under duress, the way forward. So I think I'd like to make 3 points. One is one reason economic policy is under duress is obviously a significant, severe global financial crisis, as Guillermo indicated, problems which we had thought were problems confined to emerging economies are now in the heart of Europe, and a lot of tried and true folk wisdom about economic policy now is really being called into question. I think one thing that I always try to remind myself is that to some extent the global economy got into this situation not only because of spectacular failures of financial markets, but also failures of policy. I mean, just to give you one example, and of course you had the guru this morning and Bob Mundell on the euro. But one of the reasons that Europe is in a crisis right now is because of a spectacular failure in financial markets. For a decade, every country in Europe was able to borrow essentially at the rate the Germans could borrow. And the reasoning was because you'd eliminated exchange rate risk from the transaction, there was no risk. Well, that was false. There was a risk, and it's default risk. And obviously Greece has defaulted now. And so financial markets essentially did not correctly price the probability of default. And as a result, many countries were able to borrow way beyond what they would have, without that mispricing. And so as a result, digging out of the hole now is going to be more challenging than it would have. I've argued in a Journal of Money and Credit Banking paper that the U.S. financial crisis was in part reflected a spectacular failure of financial markets in the U.S. to properly price credit risk because of this time it's different. The Rogoff and Reinhardt argument was all this financial innovation that turned out not to be well understood either by markets or by policymakers. And so as a result, the crisis was the worst in 75 years. And so we've seen really extreme, unprecedented moves in both fiscal and monetary policy. In the case of fiscal policy, obviously the piling on of government debt and the assumption of liabilities by governments. But of course there is a limit to that, and the limit is at some point, as we see in Europe, the markets start to question solvency. In the case of monetary, obviously we've hit the zero lower bound in many countries in effect, and as a result central banks have had to go to plan B, which is to balloon their balance sheets. Now so far, the consequences of that have not been adverse. I mean, Chairman Bernanke has said as recently as 2 days ago in his press conference that he thinks the Fed deserved credit for avoiding deflation. So we've avoided deflation. But I myself have real questions about whether or not the exit strategy from these balance sheet policies will come off without a glitch. And the analogy I use is that we have a very elegant theory in physics and about aerodynamics, about how to design airplanes and airplane engines, and we can do that on computer screens and in wind tunnels. But there's a reason why when we design a new jet engine or an airplane, we send it up with a test pilot first before putting passengers on it. So essentially, when central banks begin to exit from these quantitative policies, they're going to be doing based upon theoretical models and simulations, but we've never actually seen an exit like this. And so, what I would say is that, in the interest of time, is that, I think we're in for a bumpy ride. Just as people get optimistic because the LTRO in Europe was supposed to be the solution to Europe's problems, we've seen what emerges in Spain. And obviously the last 3 years, the Fed has gone into the year talking about its exit strategy, and then by the fall is putting in place another program. So stay tuned. I guess I would leave it on that and turn it over to Ron.
Thank you, Rich. So it's like Rich, I'm delighted to be here, and I'm thankful to Guillermo and David and the organizers of this event for the opportunity to be here and to speak to you. I should say that I was present at the creation of PEPM. PEPM was conceived by two of my colleagues at the time in the economics department, David Bloom and Michael Gavin. And Rich referred to Mike as one of the founding fathers, and I called him George Washington. The founding father I would most like to compare Mike to is Alexander Hamilton. I think Mike would be flattered. I think not flattered, but he would prefer to be compared to Alexander Hamilton than to George Washington. So David Bloom, was the organizer, conceived of. Put the thing through and got it on the books, as it were. But Michael was the sort of intellectual designer of this idea, of this scheme. And I was just talking to some people from the World Bank at lunch, and they've told us that this PEPM program has become a model all over the world. It's used in Japan and in Africa and France and various places like that. So it's a case of, as we know, when Alexander Hamilton and James Madison and the other guy, John Jay, when they did the Federalist Papers, this U.S. Constitution became a model around the world. So similarly, this little program, the small program, PEPM, it's not only flourishing by the banks of the Hudson, where Alexander Hamilton lived and died. It is making its way around the world as a very successful program in a very important thing, which is to create the sort of public servants, I hate to use the word technocratic, but the policy expertise. I mean, a successful economic policy, successful economic development doesn't only depend on it. Of course, it mainly depends on a vibrant private sector, but the private sector as well as the public sector need sort of creative intellectuals who not only have the technical expertise, but also the imagination and the breadth that you need in order to successfully implement and promote economic growth around the world. So I think it's a very valuable public function at a global level that PEPM has been providing, and that all of you who attended this program, you're a sort of living testimony to how well this program has worked. So let me say a little. I don't want to say very much about economic policy. There's very little time. One of the things that I notice is how much things have changed. When I first came into economics, or way back in the 1950s as an undergraduate in the University of Rangoon, Asia was the big economic problem of the world. I mean, people didn't even start to worry about Africa at that point. Africa was still colonial, but most of Asia was getting independent. There was a communist regime in China. There were newly independent sort of democratic regimes in India, Indonesia, in my own country, Burma. But everybody says, it's so difficult. Your people are poor. Where are you going to, when per capita income is so low, what kind of a saving rate are you going to have? In order to have development, you need to increase saving, you need human capital. You don't have any of these things. So for the long foreseeable future, you're going to face grinding poverty in Asia. That's the prospect. And maybe, possibly, little by little, if you can get the savings rate up from 5% to maybe just 10%, then maybe there'll be a little bit of hope, particularly if you can cut down on the population growth rate. all right? But of course, Europe, of course, was recovering from the Second World War, but then it was doing well under the European Common Market. United States, of course, was the colossus, the great giant straddling the world, tremendous engine of growth. So if you said, where is the weakness in the world economy, it would obviously be in this vast sort of reservoir of people, but no resources, which was Asia, right? So that was when I first started studying economics. I was a little bit precocious, so I started at 15 years old in Rangoon University. That was a long time. Ago. So instead of talking about the intervening period, which all of you know, I'll just jump to now, right? So supposing we look at the world today. Last week, I was asked to comment in the UN on a report by the Asian Development Bank on the last year in what they call developing Asia. That's all of Asia except Japan. What was the growth rate? The growth rate was overall, not just one country, the overall growth rate of developing Asia was 7.7%, right? Just think of that. And then there was a complaining that things have slowed down and it's not as great as it was before, but it's only 7.7%. But so I said, 7.7%. Look at the rest of the world. That's fantastic, right? And it's not just 7.7% this year. We've already had 30 years of China, 20 years of India, sort of coming in, joining the world economy, and having this tremendous spurt of growth. Now, as we know, this growth is not without its problems. There's corruption, there's inequality. The Gini index has been increasing. Asia is on the left side of the famous Kuznets curve. The per capita income is increasing, but inequality is increasing sharply also in Asia. It's increasing more sharply in Asia than in Latin America, but Latin America is still higher, so Asia has got some more room to grow on that front. So if you look at all of that, in spite of these problems, economic policy, not necessarily Western textbook economic policy. I don't know how much credit we certainly can't claim any credit for what the Chinese are doing, maybe a little bit for what the Indians are doing, but since the Indians imitated the Chinese, we can't even take very much credit for that. But somehow economic policy, certainly at the moment, is working very well and seems to be working very well across Asia, at least measured by GDP, by the growth rates of GDP and the reduction in poverty and so on. And of course, the rise in inequality is perhaps sort of inevitable, but maybe they will take steps to follow it. So where economic policy seems to have completely fallen down is in the advanced countries, all right? And it's in Europe. Europe in the 50s was going through this exciting period of the formation of the European Union through the common market. I remember at the intellectual level, we had these great books and papers by economists like James Mead and Tibor Skitowski and so on. It was a very exciting time in which the institutions were built. At that time, of course, it was tariff reduction. The emphasis was on trade. Later on, the emphasis started to come on currency, and maybe and that's where things started to get slightly out of hand. When the concept of the euro was broached, the idea of optimum currency areas, of course, was appealed to, and the creator of that great article, Robert Mundell, whom we heard this morning, his criterion was you should have a common currency if you have international labor mobility over that area. And if you use the Mundell criterion, you should not have had it, because there was not labor mobility between Greece and Germany, for example, right? But anyway, they went ahead with the formation of the euro. I don't recall Bob complaining, right? When people say that you're the father of the euro and this is such a bouncing baby, you don't want to deny paternity, as it were. So I don't blame Bob one bit for taking credit, but he should have given us a bit of a warning, all right, that you're forming this currency union, but a currency union without a fiscal union can get you into a hell of a lot of trouble. I'm sure Bob knew that. Perhaps he didn't. Maybe he should have emphasized it a bit more. But why only him? I mean, other people should have said that a currency union without an accompanying fiscal union. Like the example of the U.S. was misused, right? That the U.S. is doing well because you have a common currency across all of these 48 or 50 states or whatever it was, therefore Europe would do well if they did that. But again, we forget that there was this fiscal union. So my time is running out. David is warning me, so without more ado, I'll hand over to my other good friend, Francisco Rivera-Batis.
Thank you, Ron. And I'm trying to follow the other speakers here. I would catalog myself as Abraham Lincoln. Because I was the one who struggled through the wars, and many of the PEPM students here know, of trying to get the program established within the institution. And it was certainly a civil war that happened, and I ended up dead. So it's my pleasure to be a part of this distinguished group. And of course, it was my pleasure to be part of PEPM. As you know, I have remained teaching as part of the program. So we don't have much time, actually. I think I've already taken up my time. So I'm going to have, what I'm going to do, I'm just going to talk in general about this issue of policy making, but I'll bring in a specific case, the case of Spain, and because it reflects, I think, the follies of policymakers, as well as some of the new nuances that policymaking is taking. Since the creation of the euro and the European Union, Spain actually was doing very well up to 2007. Growth in GDP per capita was at record levels. Real wages were increasing, again, at record levels in terms of the country. Unemployment was declining sharply. At some point, it was at the single digits, which it had not been for many years. Interest rates had gone down, something that I think Rich mentioned, and they were converging to those in some of the other European countries, including Germany. The exports were increasing, especially within the European Union, which was part of this process of integration. The service sector, construction was booming, the banking industry was expanding. The government was in pretty good shape. It was actually in a surplus in 2006, and deficits, which had been higher, they had been basically wiped out, government deficits. Everything seemed great. Even Spain won the European Cup. The country was celebrating, and all of a sudden, there is this crisis. And for a period of time, a lot of the population just couldn't accept it. Zapatero, who was in charge at the time, he said, well, this is temporary. And then the recession was worse. He would say, well, it will pass. And almost for a year and a half, there was almost a denial on the part of the government and on the part of many in the country. But it just got worse and worse. So we see all of these indicators move in the other direction. We see a collapse of GDP per capita. We see what has become really not a recession, but a depression. Unemployment rate is above 20%, way above 20% among young populations, the young age group, 17 to 25. Unemployment is about 50%, about 50%. Interest rates have gone up, and the spread with respect to Germany has increased sharply. The government has a huge budget deficit. So we ask, what happened? What went wrong? And so as we looked at those very positive indicators, we see some negative indicators that policymakers were ignoring. And I think that's one of the problems that we have in policymaking. We really need to incorporate behavioral, or the new behavioral economics, into the behavior of policymakers. Because when everything goes well, we tend to think, we tend to overestimate, to be overconfident, to overestimate the good that is happening. We think that it will continue. And that was a big problem. So underlying these years of growth and reductions in unemployment and so on, we have a situation where prices were going up. There was inflation. Yes, real wages were going faster. Nominal wages were growing faster. And so real wages were increasing. But both of these basically were leading to a real exchange rate, a real currency appreciation, and a gradual loss of competitiveness. And you start to see this in the fact that although exports were growing, imports were growing at a faster rate, and you had a deteriorating current account balance. Now, this deteriorating current account balance, by definition, was also associated with capital inflows. And these capital inflows were huge. As this current account balance was growing, becoming bigger and bigger, the capital flows were as well growing. And they financed this expansion in the construction sector, this boom in the banking industry, which, as we know, collapsed. We had a bubble similar to the one that we had in Ireland or the one that we had in the United States. All of them collapsed. And so we have, in a sense, a situation similar to the one that we had here in the United States. And then associated with that is the collapse of not just Wall Street or Madrid Street, but the collapse of Main Street. So we have stock market crash. And so we have all of the structure basically collapsing. So now what are the lessons of this? Now, partly we have seen this before. This is a classical case. The East Asian crisis, go back to Chile, the number of countries. It's a classical situation. We have capital inflows. One can say the same thing. I mean, Rogoff and Reinhardt had said the same thing of the United States. You have what starts everything is this flow of capital coming in, which generates somehow in some sectors a speculative bubble. In some cases, maybe different from others, but in many, it is a real estate boom, a construction boom. And this bubble then eventually bursts and it generates all of these consequences. So this is, again, something that we have seen before. So in terms of policy, what policies can prevent this? We're not even talking about that. What policies within the European Union, which was the trigger for capital flowing into Spain, what policies could we institute that could slow down that capital going into Spain, into Greece, and into other countries, because it was similar what was happening in other Mediterranean countries as well. Well, we haven't talked much about that. China has instituted taxes on speculative real estate transactions and so on. There are a number of policies that we can follow, but we're still not even talking about that. And it's going to happen again. We'll have the capital flowing into a country, and everybody's happy, and international reserves are growing, and the economy is a construction boom, and eventually there is a crisis. So it is something that I don't think we have learned to appreciate and to generate policies to manage that. There have been policies mentioned in the past, but still there is a lot to think about that. The other thing is the part about trade. So we have this real currency appreciation. Now we have a lot of trade. You know, this was part of the goal of the union, was to generate more trade within the union. But what do we have? We have something that Professor Mundell likes, but Professor Bhagwati doesn't like. Because Professor Bhagwati has been arguing that this is not the right approach to trade, that what we need actually is to have multilateral trade liberalization, not trade liberalization that generates these groups, these unions, these customs unions, which generate a lot of trade within some countries and tend to generate a lack of diversity of the exports of countries because what it encourages is trade within a region and discourages trade outside the region. And so you see a lot of the trade of Spain being with the rest of the European Union. So it tends to specialize in that. So if other countries in the European Union collapse, well, Spain will collapse as well because most of its exports are to other countries within the Union. So that is another issue that one has to consider in terms of policy. Again, it's something that we have adopted. We want to liberalize capital flows. We want integration of trade, but it's within certain countries. NAFTA, we have CAFTA. We have all kinds of these free trade unions, and you have to be very careful. Mexico suffers from the same problem in terms of the United States. When we had our Great Recession, one of the countries that was most deeply affected is Mexico, because Mexico, 80% of its trade is with the U.S. and Canada. It's the only country in Latin America that is that way, and it's because of this relationship. And you look before and after NAFTA, you see a huge expansion of trade with the U.S. and Canada. So this, again, it is something that we have known for many, many years. I mean, you have Jacob Weiner decades and decades ago talking about this issue, and it emerges as well when this comes out. Now, let me just stop because I ran out of time. A long time ago, I think, going back to Lincoln, where it's out of time since that time. But there are issues as well relating. We've talked about monetary union being associated with a fiscal union, the issue of a lack of exchange flexibility, lack of monetary policy, and so on. What I'm saying is that I think a lot of these policy issues we have. There are some nuances and so on, but we have a lot of experience with that. It's just that it's somehow sometimes we keep making the same mistakes. They appear maybe in different contexts, so you have to watch out for them, but we keep making the same mistakes. Thank you.
Okay, I'm going to indulge myself in just a moment of conversation about PEPM. I remember only a few of you are here from the early days of the program, but we had a lunch, a sort of celebratory lunch with the World Bank, and Larry Summers came. Larry Summers was actually the evil genius behind the program because it was he who decided to set up the scholarship program, the World Bank scholarship program, or at least he was the main driver of the idea that made the program possible. And at that lunch, he said that this program may be the most important thing that the World Bank did during his tenure as chief economist at the World Bank. And you can take that either as a comment on how he felt about the World Bank's mission, or maybe a little rhetorical flourish, I don't know, about the World Bank. But I do know, speaking personally, that there's nothing that I have done or will do in my professional life that compares with the pride that I feel in all of you and the program that brings you here today. Also, I want to acknowledge the Betsy Ross of the program, Cecilia Barcelos, who's in the second row here, who was the administrative genius of the program. Without her incredibly hard work and dedication to the program, this would have been really a figment of a bunch of academics imaginations, and it's something more than that in large part because of her, and I'm sure other unsung heroes of the program since, but I know what she put into the program. Those of you who were here when she was here know as well. And I'm also kind of grateful she's not up here because I really like Alexander Hamilton, but she'd probably be thinking more like Robespierre or Joseph Stalin. I don't know, but I'll leave it at that. I'm actually not anymore doing emerging markets at Barclays. I've moved onward or downward to global international macro strategy / asset allocation, and I'm struck as I look more and more deeply into the big global stories, Spain among the most important of them right now, how well equipped I think you guys would be to address those problems. And so I want to start with a comment or two on that, but then I want to make a second loosely related point to remind us all just how hard it is. Okay, it's one thing to have the academic knowledge, it's much harder to apply it under the kinds of circumstances that policymakers, for example, in Spain faced 5, 6, 7 years ago, and market participants and intellectual leaders. Okay, so first you get the idea because one of the intellectual giants that you study is Guillermo Calvo, who has explained with co-authors the economics of sudden stops, and really at the heart of it, that's what's going on in Europe. Set Greece aside. Greece is a spectacularly different case than the rest of Europe. It's really a sudden stop, and you understand how intractable those problems can be, how they can spiral out of control as they are doing now in Spain, in Portugal, and could happen in Italy. You understand, I hope, the work that Ernesto Talvi, who's in the front row, has written about the difficulties of managing fiscal policy in booms. The sort of difficulty of maintaining an appropriately cautious fiscal stance during boom times so that one can have an appropriately supportive fiscal stance in bad times. I want to come back to that in a second, But I hope you also have learned something that was very much in my mind when I was in my scribbling years, and studying pro-cyclical fiscal policy in Latin America, that you can't always get there from here, right? The question is, how can we put ourselves in a position where we can have a counter-cyclical fiscal policy? For Latin America in the 1990s, the answer was you'd have to start over again, which they did, right? Which they did, and now Latin America, by and large, is in a position to run a counter-cyclical fiscal policy, but much of Europe is not. You get that. I am not sure that relevant policymakers in Europe do now. And I hope as well you studied plenty of Bob Mundell, another intellectual giant who you should feel incredibly privileged, as I do, to be associated with. But not the Bob Mundell of the Mundell-Fleming model, not the Bob Mundell of optimal currency areas, but the Bob Mundell of supply-side economics, which really is a way forward, the only plausible way forward for Europe to make, Southern Europe to make, the wrenching structural adjustments that it has to make. Spain has to shift from a construction-dominated to a manufacturing economy, and you can't do that if it's prohibitively expensive to hire workers because you can't fire them, right? And this needs to be, I think you would get that more than people who are running the show in Europe do now. But let's be careful not to, just because we know the relevant theory, think that it's easy. And I want to ask the question, or pose this as a question, who got it wrong? Was it policymakers? Was it academics? Was it markets? And the answer is kind of everybody, but they got it wrong because of one, I think, predominantly because of one reason. They underestimated the impact on whatever it was that they were looking at of the global credit boom that was triggered, mainly by the Fed, in the early years of the 2000s, in the middle of the 2000s. So the Fed understood, and I know from talking to them at the time, they understood some of the risks they were running, but they didn't understand that things that had never happened in America's modern history could lie in store behind them. There was a lack of imagination about what the downside of the credit cycle that at least some responsible people in the Fed understood was in place could be. In academia, let's not forget, while we're talking about the reckless irresponsibility of financial markets that levered up in the middle of the 2000s, that half the economics profession or the macroeconomics profession was patting itself on the back for what a good job they had done in eliminating the business cycle through enlightened monetary and fiscal policy making and creating, what was it called? The Great Moderation. The Great Moderation. Thank you.
They equal Olivier Blanchard.
Let's not name names. But because it was a natural mistake to make. And these are not stupid people who are making these mistakes, but really in the end it was the credit bubble that was making it impossible to see the risks that lurked underneath the surface of the existing financial order. And then markets, of course, got it wrong, and I think largely because they too had a lack of imagination. It really wasn't, in my strongly held view, greed or recklessness. It was the fact that they didn't understand how easy it could be that something that had never happened in the recorded history that was all they had to work with would happen. But it did. So these things all go together. Easy to say, well, run a structural budget surplus during good times and then you'll be able to run a deficit in bad times. Fact, in Ireland, the country other than Iceland, which has had the biggest boom and bust, in the 2007 IMF Article 4 report, the fund congratulates Ireland for running a structural budget surplus of 0.5 percentage point of GDP in 2007, or that was the forecast for 2007. So yeah, it could be a little bit bigger, and it was a little smaller than they would have liked to see, but it was a structural budget surplus on their reckoning. The IMF's current estimate of what the structural budget deficit was in 2007, now with the benefit of hindsight, 8% of GDP, right? So we're not talking about small, kind of little differences of understanding that complicate matters. It's really hard. It's really hard as an intellectual matter. You don't have, I'm not going to put it that way. You don't have to attribute bad faith to people who make mistakes in a world with fundamental uncertainties that are as large as the ones that you will face as policymakers when you graduate, or you are facing if you're policymakers today. I had another fun point to make, but I'm running out of time, and so I will leave that to my next appearance, I hope, in 20 years. Thank you all for being who you are and for making the program what it is. I feel like a proud father. Thanks.
Well, we had very exciting and inspiring first round of comments. I think it came out clearly that, no matter how much we study the real economy, how much we discuss it in PEPM, there is a high degree of uncertainty out there. It's easy to identify mistakes after they happen, very hard to be able to tell them before they do. We don't have a lot of time, and I would like to open to Q&A. But let me sort of open the Q&A part with one question looking forward about the policy mix, and particularly looking at Europe. I mean, in the discussion, you hear people talking about that in Europe, fiscal expansion, fiscal austerity is a mistake. Is that really a mistake? Should that be given up momentarily and maybe take up a much more expansionary fiscal stance in Europe? And if that is not done, what about monetary expansion? I mean, the ECB has done a lot in that respect. Is that enough? If you think about an issue that Michael Gavin and his group has studied, and that is the shortage of safe assets, it's not clear that by expanding monetary supply in the short run of reserve currencies, you're going to generate more inflation. So maybe it's a time to do it. I don't have an answer. I'm just saying, is monetary expansion something that we should pursue, that maybe the U.S. should go into QE3? I don't know. But that's a completely different strategy. And then a third tack, which is somewhat different from the other two, is more of a financial sector policy. Example, the Eurobond. Would that be a solution for Europe? On the surface, when you look at the whole of Europe, Europe is in good shape. No big deficits, no big current account deficit, no big debt. So it's possible, perhaps, if they get their act together, that interest rates will go down, not to the levels of Germany now, but much, much lower for certain key countries like Spain or Italy. I don't know, but it's quite possible that that would happen. Of course, that would require some union. I don't know if you want to call it fiscal union or not, but if you do, and you do some little exercises assuming the much lower interest rate that could prevail in the region, all of a sudden you have a region that is workable in a difficult way from a political point of view. But these are the issues that I would like the panel, if they wish, to discuss later on. But let me open now the floor for comments. Please. Do we have, just a second, a microphone is going in your direction, please.
I'm a sustainability sociologist who tries to integrate the social, economic, and environmental dimensions of sustainable development, and which is another way of talking about global governance, but an integrated global governance rather than only a global economic governance. I have a naughty question to the 4-5 economists at the days. And the naughty question is this. The present system, debt-based system, is based upon scarcity. What, in your opinion, are the barriers of having the economic, so-called dismal science, look at an alternative that is based upon credit, as people like Robinson in the UK, David Corton in the US, and others have been proposing? What, in your opinion, are the barriers to this kind of emergence of this alternative kind of financial, economic, and also monetary system? Thank you.
Okay. More questions?
Hi, my name is Jimmy Isu. I'm from the PEPM 2008. And the question is, you already mentioned in the panel that we have this problem of the black swans, this problem of misunderstanding the risk. You cannot assess appropriately or the risk. And that's one of the facts that was involved during the crisis. And as I remember in the paper of Augusto Latorre from the World Bank, or also in Andre Schleifer, new comments on the crisis, they mention a lot this issue of what is the cognitive issue regarding the financial industry. This problem that you become too optimistic during the booms and too pessimistic during the crisis. But the problem also involves the policymakers. Policymakers, too, are too optimistic during the good times and pessimistic during the bad times. And that has been seen also when you see how the financial regulation moved from Basel I to Basel II, relying a lot on the industry, and then going to Basel III after the crisis, becoming more restrictive, less reliant on the markets. But my question is, what would you think would be a good solution for this? Do you think that these new counter-cyclical policies that are mentioned in Basel III, or in these new arguments regarding the importance of counter-cyclical policy, would be a good solution for this problem of being too optimistic, too pessimistic, or don't you think that would help?
Hello, I'm Patricia Seeks. I'm also PEPM 2008. Professor, you did yourself a disservice, I think, because you were an economist who did spot some problems before they were problems, some problems before they were mistakes. I seem to remember something about dark matter being off the books, but I can't quite remember it all. Other people saw the big Euro countries breaking their own fiscal rules about how much they could grow their deficit. And I wonder whether the UK has also walked into a mistake with its own fiscal policy now as it entered double-dip recession last week.
No.
Should we start to
We have enough questions, yes.
The people might forget. I mean,
Yeah.
3 good questions. So.
Let me jump in on a couple of those points. I think it's important to remember, and this is actually a good example of what Mike was referring to, that we always need to be careful when we talk about policy and now focus on fiscal policy between the chalkboard model and what you face under certain circumstances. And for a lot of countries, and I would put the UK in this category, it was really not an option to defer the fiscal adjustment, because had they deferred, their bond yields would have gone up 100, 200 basis points. So that's what I thought, and I think it's plausible. So the textbook models say run the fiscal expansion and borrow at the rate you could before. But if you're in this sudden stop, again, we're sitting next to the father's son, if you're in a sudden stop with contagion, then you don't have the option to borrow where you could in 2007. And so the choice is you get the contraction through skyrocketing interest rates, or you get the contraction through a reduction in outlays. But you're going to have a contraction anyway. So I think there are a couple of countries. The U.S. has been able, because of the exorbitant privilege, to sort of live by a different set of rules. And as Mike said, many emerging economies ran surpluses in good times, so they have that leeway. But I think many countries in Europe probably didn't. On the point about what getting it right and getting it wrong going forward, I guess I would say that after the fact, and again, let me say this is. Anything I write or say on this does not have an element of "I told you so," because I didn't, and so, but I mean, it's liberated me to think about this. And I think 2 things that a lot of us got wrong, and yours truly, is that, and Mike said it very well. I think because we had never seen a huge explosion in credit that had occurred off bank balance sheets, there was a false view of safety. Everyone knew there was a credit explosion, but from Greenspan on to many people in markets, the system was viewed as being stable in the last decade because it was all being securitized and was actually not supposed to be on bank balance sheets. And as a result, when it did all make its way either directly or indirectly back to big banks, then the system was much more fragile than people thought. Now, the good news, however, is that we don't have to worry about that again. You don't see an explosion in opaque, levered CDO structures out there, not because they've been made illegal, but nobody wants to buy them, right? So the good news is that the next financial crisis that we have won't look like this one, okay? We're actually quite good at fighting the last war. As the Latin American experiences have taught us. Long-term capital was viewed as a huge threat to the financial system in '98. In the last crisis, 1,000 hedge funds went on and barely created a ripple. So the financial system and regulators are actually, policymakers are actually pretty good at avoiding the replay of the last problem. The challenge, as Mike said, is that these same issues emerge in other pockets and they're hard to identify.
Okay. Anybody else?
Yeah, I agree with almost everything Rich said, but I'll address the question about over-optimism and over-exaggerated pessimism with just a little bit of a. We don't fight. We can only fight the last war effectively if we understand well and accurately what happened in the previous war, and that's why countries like the U.S. have war colleges, right? They obsessively study previous wars, and they're still arguing about how the Franco-Prussian War was won or lost. And we're still arguing about the last one to an important extent. So I agree 85 to 90% with what Rich said, but I would say first, I think that part of the explanation for the weak policy response in Europe to the downdraft that they've been suffering now for really 2.5 years, has a lot to do with a combination of poor understanding of what happened in emerging market economies in the 80s, the 90s, and the 2000s, and a kind of arrogant view that it couldn't possibly be relevant for them, right? How could Greece, a member of the Eurozone, have anything in common with some squalid emerging market economy where they don't even speak French? I think there's something in that, and I think a lot of the well, let me just say that. I don't think that we have in policy circles a broad enough historical and geographical understanding of history and an openness to recognize that these episodes, although different in important ways, also have very important lessons for them. Let me say, now this is going to touch upon a point that Guillermo raised, and it was the point I wanted to discuss, but thought it would be self-indulgent, so I'll be self-indulgent, and that is the idea of a safe asset shortage in the world economy, which I think is an important part of the explanation for what went wrong in the run-up to 2007. And I have this 35 years I've been a professional economist, and I have one chart that I love, but I can't show it to you because I don't have it on the computer, but I'm going to kind of describe it to you. In the early 2000s, say 2002, if one looks at assets that most of us would consider, let's say, reserve quality assets, U.S. treasuries, bonds, and public debt of major European economies, asset-backed stuff, which was then AAA, certainly considered close-up agency debt in the U.S., it amounted to sort of about 42% of world GDP. International reserves globally were about 12% of GDP. And that's an important number because those reserves are invested almost entirely in assets like these. And so they're kind of like a price-insensitive claim on the stock of safe assets. By 2007, the stock of so-called safe assets had shrunk by about 5 percentage points of GDP, and reserves had increased by about 5 percentage points of GDP because after 1998, mainly because after 1998, EM policymakers rightly decided they needed more self-insurance because, God help them, they certainly didn't want to go back to the IMF. And that put a squeeze that even before 2007 was being identified by smarter guys than me, like Ricardo Caballero, was a major driver of world asset markets. Then 2008 comes, and we lose asset-backed.
Right.
We lose agencies temporarily. We probably have them back on the list. And then 2011 comes, and we lose Spain. We lose Italy. And at the moment, the gap between the supply of these safe assets and international reserve holdings of them is sort of like about 5 percentage points of GDP as opposed to 35 percentage points of GDP in 2000. This is an important driver and a scary one because if you think about what happened in the asset-backed explosion, it wasn't a NASDAQ bubble type situation where people were, woohoo, I'm going to retire on this AAA security. No, this was Landesbanken in Germany, and guys basically very conservative investors, not very good necessarily at themselves evaluating global credit risk, who were being priced out of the traditional AAA credit assets by central banks who were gobbling them up for their international reserves. It was a weird bubble, right? It was a very weirdly generated bubble, and it happened because the world was hungry for safe assets. Well, I would not be too comfortable, given the magnitude of the tension that exists, that we won't see a response not unlike, it won't be identical, of course. It won't be U.S. housing asset-backed securities that attempt to plug the gap. But already Citigroup is thinking about securitizing trade receivables, mainly because of the new regulatory framework. But there's a hunger for stuff like that because there's not enough treasuries to go around, and that doesn't go away. So we do have this huge tension in the international financial arena now that really doesn't go away until emerging market economies, i.e. China, become part of the solution. Because advanced economies are too small, and even if they weren't too to support the demand for safe securities. There's a Triffin dilemma going on there. And we're growing too slow. So even if we weren't too small now, which I think we are, we would be 10 years from now. Huh? So this is kind of comes back to Bob Mundell's point earlier this morning, and from a different angle kind of says the world needs China to be part of the international monetary arrangements, and it's not really going to be a safe place until then, because there's really no place else that can relieve this tension between the demand and the supply of safe assets.
Okay. Francisco?
Well, I don't want to really talk too much, but I do have to say that there were policy changes that were made in the U.S. That favored, maybe didn't cost, but led to this bubble this credit bubble that we have been talking about. There were changes that were made to banking regulations that I think were consistent with what happened, or fostered, or provided incentives. And I think we also we had a number of economists, and not just Paul Krugman, but others who had for years had identified or what they thought was a real estate or housing bubble. But there was always a question about is it really a bubble? And the bubble continues. And is it really a bubble? And then when it bursts, you say, oh, yeah, it was a bubble. It's too late. And again, I keep saying, I think there are some lessons that we have learned, and that part of the problem, whether in the private sector, which maybe lobby for changes and so on, or the public sector, in both cases, there is this behavior of over optimism, of ignoring what is happening, and continuing, moving ahead in a certain direction that eventually leads to a crash. And there are those who identify, who say, look, we're going to fall off the cliff. And people, policymakers, and those in the private sector as well, just keep going. And so I just want to say that I think that we have, I think you have a lot of lessons. And let me just briefly mention, I was in Argentina during the crisis there, where maybe a few months later there was a change in regime from the currency board. They let the peso float. And at that time, I met with some PEPM students who, I hope maybe they're not here, I hope they're not here, who, and I told them, Argentina has been going through this crisis for I don't know how many years, 4 years. You just have to, just let the peso float. That's what you have to do. And they kept saying no, and they worked for the one of the ministries, and they were advisors, and they kept saying, no, that will lead to hyperinflation. If we let the peso float, it will lead to hyperinflation, and we want to avoid that. And I said, no, it's not going to lead to hyperinflation. I mean, if it said, we taught you that inflation is caused by growth of the money supply. And if the central bank controls the growth of the money supply, yes, there will be some inflation, but there will not be hyperinflation. There will be change in prices over a temporary period, but no hyperinflation. Will not be 200, 300%. They were scared about that. And I told you that. It's in my textbook. But they kept saying, no, that's not. I kept arguing with them for about an hour, and I sort of gave up. And again, it's something that blinds us, it's something that we tend to ignore what we have learned in our behavior. And I think a lot of this, I think we have to bring in behavioral economics to also understand how policymakers and the private sector as well, how they behave. And that's just, I'll stop there.
Ron? Yes, I'd just like to ask my fellow members on the panel a question on behalf of the audience, perhaps. I think Rich Clarida mentioned that he thought Great Britain really had no choice but to adopt the austerity program, right? Given their situation. And presumably the same would apply to other European countries. But as he said, using the phrase of our friend Barry Eichengreen, the United States has this exorbitant privilege, right? That it can sort of print money that the rest of the world is willing to accept. So Keynes could not be used in the country of his birth. But the question I want to ask is, particularly to Mike, but also to the others, is could not the good Lord Keynes be invoked rightly on behalf of increasing production, employment, and mitigating the sense of crisis by an more expansionary fiscal policy in the U.S. This would presumably create more of the safe assets that Mike was talking about that are short in world supply. And could this jolt emanating from the United States have favorable repercussions in Europe and the developing world? So while Keynes doesn't apply in Asia, he doesn't apply in Europe, might the one place that he applies still be the United States? If the answer to that is yes, then I think there's hope. We don't have to go on struggling through this system. But even if he does apply, we know that it's almost politically, it's hopeless from a political standpoint. But from an intellectual standpoint, could such a case be made? So I would like to hear from any of my colleagues, but particularly Mike Guillermo, and Francisco and I are trade and development guys. But these three finance macro guys, I would really like to know what they would think about that.
I'm sure that Rich has something to say about it. We have to be brief because
yes or no answers only.
My answer is, I'll let Mike take that one.
Mike, I really wanted your answer.
I think
our friendship will survive, Mike, regardless of what you say.
I think that actually it's the ability to run the technical, let's say the market capacity to run more expansionary fiscal policy than is currently being run, I think exists in the U.S., in Japan, and I would argue the UK. I think it's wise for the UK to be doing what they're doing for political reasons and because anything else would be simply shoving fiscal quote-unquote stimulus from one period of weakness into a subsequent period of weakness, sort of like this moronic cash for clunkers program that we had, which goosed U.S. car sales for a quarter and then led to a collapse and an equally weak quarter of the economic recession. I'm not convinced deep in my heart that it would be effective, especially in the United States, because Keynes was very wise in many ways, but so was his compatriot David Ricardo. And when you have a circumstance where the compensatory fiscal response to an easing of fiscal policy now is not some future generation, but within a 5-year planning cycle, I think the issues of Ricardian inequivalence and other stuff arise, and so yes and no.
Okay, well, we will have to wrap this up. Let me just say, in closing, that there is an issue. We've been talking about optimism and pessimism and bubbles and things like that, and we don't have a good theory for that. That's a problem. I mean, we are in a university now. From an intellectual point of view, we are at a loss in principle. My interpretation is that we are also more at a loss that we should be, because we have ignored issues of liquidity, money, and so on. We shove them under the rug, especially in modern monetary theory. There is a lot of that going on, where money is an endogenous variable, and therefore all that goes with money, liquidity stuff, is lost from the view. And that's a reason why we ignore some of these problems. So I think we have to realize that liquidity is a mirage. I mean, cash is a mirage. It's worthless. And however we are prepared to hold it, and people are prepared to give us real goods in exchange of cash. Well, on top of that, you can have many steps and make it very complicated, which I think partly is what happened. And we let that happen without taking into account the fact that we were creating what I call fake money. Without a lender of last resort, that's fake money and can collapse anytime. So I think that's where optimism and pessimism, that probably applies to everything that the human being does, applies particularly in a bad way, because you can coordinate and all of a sudden you destroy massive amount of cash, which is my simplification of the point that in a way Mike is emphasizing the fact this destruction of safe assets was partly a result of having created them without a real basis. But we should not be surprised, because liquidity takes that characteristic. It's basic. It's in the nature of liquidity, and it helps as a means of payment. But you need to support it, and we didn't pay enough attention to that. So to finish and replying to Ron, my concern is that some of this expansionary fiscal policy is doing something for the poor now and having the poor in the future pay for it. I mean, if we do that now, increase the deficit, increase the debt.
I wasn't thinking about the poor. I was thinking about the unemployed. They're not the same as the poor.
Well, I'm saying, the disadvantaged. Okay. Let's say today, for the disadvantaged tomorrow, the retirees tomorrow. I don't think the very rich are going to be paying for this. And even if you make them pay, I mean, the Buffett rule or whatever, we know that doesn't amount to much. So finally, you have to get your hands into the pockets of the middle class to make a difference in the future. So it's not clear that by expanding fiscal policy now you're going to make a difference. But more to the point, I'm concerned that the problems that we are discussing is, for example,
Ricardian equivalence sort of idea.
Sort of, right. But in order to give a name which doesn't belong there, because the poor Ricardo never intended. Right. Actually, he said explicitly that he disagreed with that point of view. So we think, keep calling it, we should be the Barrow
equivalence.
The Barrow equivalence, right? So it's partly that, but also because some of the problems that we are facing now, as the gentleman in the back was mentioning, is the lack of credit to small and medium enterprises, households that are over-indebted. All of those issues are financial. And maybe by doing something on that front, which is not easy, you can unleash demand and credit and so on, and then the system can start working by its own forces. So the concern is that fiscal policy is a very brutal way of doing things, and you fall in the hands of politicians. If you've been following the discussion these days among politicians, I mean, you get really scared that you give them money to spend. So, well, with that, I wish we could continue, but David is making all kinds of faces to us, and there's no way. So thank you very much for the panel, for a fantastic